This is a correlation report. So there's a little bit of an art in terms of how we build portfolios. If we're going to allocate X amount into US stocks, what percent do we want to maybe have in international stocks for diversification, but also for risk reduction? How do global bonds or bond market investments pair with real estate? So when you're putting a portfolio together that is meant to be very diversified, again, what I'm looking for is I'm trying to produce consistent returns. And certain investments will play off of each other, or they'll be correlated with each other. You know, if you see red, you see higher correlations. The one observation that I would make is in the top right-hand corner, if we look at global bonds compared to global equities, and we see that discolored green of 0.4%. You know, stocks and bonds are not extremely low correlated assets. There is an element of correlation there. What I want to look for is how do I really complement what's the largest asset in most client portfolios, which is going to be stocks. And again, global stocks, US stocks provide exceptional returns over long periods of time. So this discussion here is not meant to really put down the benefits of owning stocks for the long run. It's just, what do you own other than stocks? As most investors will struggle to keep their stock allocation if their stocks are down 20, 30, or 40%. And this is something that we're constantly looking at to say, okay, how is our private allocation going to mix relative to our bond portfolio or our stock portfolio? How does the private lending mesh relative to the bond market, and how do we develop an allocation appropriately for clients? So this is a fascinating piece that really lays out many of the different investments or assets you can invest into, and how do they play off of each other. What we don't want to have is investments that are all highly correlated so that your portfolio is moving in unison, and when those investments drop in value, it's going to be hard to stick to that allocation. And also, you really do not have a significant rebalancing opportunity. For us, rebalancing is the key piece of managing risk and providing performance over time. Well, you need something to do well when something else drops so that you can rebalance and use that drop as a potential buy low opportunity. So that's what this piece is sharing, and just a little bit of some of the research that we're doing. Patrick, why don't you have a few thoughts on this, which is really looking at a number of different assets and performance on a yearly basis from 2015, but far right, we're looking at volatility or fluctuation coupled with returns. At least what jumps out to me is that 60-40 that we talked about, stocks to bonds, versus the 50 stock, 30 bond, 20 alts. What are some of your observations, or what do you see when you look at something like this?
Yeah, so in the industry, we call this a quilt chart, and it looks like a quilt, and but it really is, each box represents a different asset class. A lot of these are private markets versus a 60-40, which is a composite of stocks and bonds on the public markets. And I think the slide before and this slide highlight what we were showing in the beginning. The lines in the charts were not behaving the same. Why? Well, what you see is the underlying composition inside of them. They behave differently at different times. And so what I see here as an observation is one reason to invest in alternatives or any of the private markets is really, even after a recent sell-off, you can see in 2023 and in 2024, both public equities and public fixed income have had, they're not exactly cheap. So they've had 2 great years in a row. And we don't know, you can see in 2022 what happened in the 60-40 portfolio. Essentially, you know, there's a period of time, or there are some expectations that rates could go up potentially, or rates could be held, but the longer end of the rates, the 30-year and the 10-year, may go up, even if the short end comes down, meaning the rate you can borrow at. So really what that means is the probability of a 60-40 portfolio outperforming all these other assets has not happened going back all the way to 2016, 2015 on this chart.